What's left now is manufacturing overhead, which is often referred to as MOH, manufacturing overhead. Now, previously, direct materials and direct labor, it's economically feasible for us to track the direct labor, the direct materials to the specific jobs through the process of the requisitions used for materials and the timesheets or time records for employees. Indirect manufacturing costs, however, by nature of us defining it as being indirect, means that it's not economically feasible for us to track it directly. So we're going to find a way, a mechanism to take those indirect costs and allocate them to jobs. But the key word is allocation. So what we're going to be looking at doing is what is referred to as allocating. And that means we're going to be splitting up, dividing total MOH, manufacturing overhead costs, among the jobs produced during the year. The example of indirect manufacturing costs, we know that direct labor is direct. We know that raw materials or direct materials are direct. Here are examples of indirect costs: depreciation of factory equipment, utilities, property taxes and insurance on the factory equipment maintenance, salaries of factory janitors and supervisors. Remember, manufacturing overhead, manufacturing means they have to be manufacturing costs. We're not talking about administration. We're not talking about selling costs. We're talking about manufacturing costs. So all of these costs, we have determined, someone has determined, that they would be difficult, if not impossible, to assign directly to a job. So we're going to have to find another mechanism, another way of allocating those costs to the job. So how do we do that? Allocating manufacturing overhead costs to job. There are several steps to this. The first step is we're going to estimate the total manufacturing overhead costs for the coming year. And when we talk about estimating, this is something that we'll do likely once a year, and it'll be part of the budget process anyway. So we're going to look at all of those costs that we just identified earlier: depreciation, utilities, property taxes, equipment maintenance, salaries of factory janitors and supervisors. We're going to take all those costs and we're going to plot them out for an entire year. We have to do a budget anyway, so this isn't any additional work. This is something that we're already doing. Step 2, we're going to select an allocation base and estimate the total amount that will be used during the year. So we're going to try to find what we refer to as a cost driver. And when you think of a cost driver, we need some type of activity, an activity that we can monitor, that we could track, that hopefully we already track it. We already have it in our system. So it's not something that we're going to have to create or new to the circumstance. So a cost driver is something that drives the cost, and we're going to use that cost driver as an allocation base. Step number 3, calculate the predetermined manufacturing overhead rate using the information estimated in steps 1 and 2. So we're going to come up with a rate, and the way we come up with this rate is we take our total estimated manufacturing overhead costs. That's the budget. That's what we talked about 10 seconds ago. And we're going to divide that by this allocation base, this driver, whatever we come up with. Hang on to that. When we come to it, it'll make a lot more sense. But just start to remember that we're going to come up with some type of manufacturing overhead rate. It's predetermined, meaning we're going to do this before the year starts, whatever the year. Let's say if we follow a calendar year, it's January 1, we'll have all of this budget process completed likely by the end of November and the beginning of December. So we'll have this predetermined MOH rate ready to go by January 1st when our year starts. And then the last part is allocate some manufacturing overhead to each individual job as follows. We'll take whatever this rate is, the predetermined manufacturing overhead rate, and we'll multiply it by the actual amount of the allocation base used by the job. Okay, so what will the job record look like after we've done that? Well, we've already talked about how we're going to get the materials assigned to the job. We're going to use requisitions to track product that's taken out of the warehouse and put onto the production floor. We're going to use timesheets or time records to track direct labor. And as that information is gathered, we're going to assign the direct labor costs to the job record. But now what we're going to do is use some type of allocation process to take manufacturing overhead costs and allocate them to the job record. Let's demonstrate how we'll come up with the predetermined MOH rate. As the slide suggests, we're going to take our total estimated manufacturing overhead costs and divide it by the total estimated amount of the allocation base. First, we have to come up with the manufacturing overhead costs. So as an example, let's say during the budget process, before the beginning of the year, we're going to come up with a complete budget, and this is going to be the section of manufacturing overhead. So included in this section or this budget is going to be depreciation, repairs and maintenance, utilities, factory taxes and insurance, and management salaries. Now, according to this, I need my total estimated manufacturing overhead costs. So depreciation is going to be $200,000. Repairs and maintenance, we're budgeting for $700,000. Utilities is $300,000. Factory taxes and insurance is $100,000, and management salaries is $300,000. So I'm estimating, I'm budgeting, I'm estimating, I'm coming up with my total estimated manufacturing overhead costs to be $1,600,000. So the next thing I need to know is the total estimated amount of the allocation base. Well, I need to make a determination of what is going to be my allocation base. One commonly used allocation base is direct labor hours. And here's the logic. What we are suggesting is that if I have more direct labor hours, I'm going to have more depreciation, more repairs and maintenance, more utilities, more factory taxes and insurance, more management salaries. This isn't perfect. You're not going to get a perfect relationship with any kind of allocation base. In fact, this is a broad generalization. But remember, in management accounting, we just need good enough information to make good decisions. And so we might come to the conclusion that this, since we're already tracking direct labor hours, it's a pretty cost-effective approach. And if it's cost-effective and it gives us a reasonable number to work with, then let's go with it. So what do I need to do? I need to estimate the allocation base for the entire year. Well, these costs for the entire year come up to 1.6 million or 1,600,000. And in that budget process, believe it or not, we get very detailed in a manufacturing budget. We'll go ahead and we have to figure out what our wages are going to be, our total labor costs. So we're tracking the number of hours we're expecting to have for the entire year. Let's assume, to make this a pretty simple computation, let's assume that we're coming up with 100,000 direct labor hours for the entire year now. 100,000 direct labor hours. That's our budget. Well, the formula says take your MOH, your manufacturing or estimated manufacturing overhead costs, and divide it by the allocation base. Well, we're using direct labor hours. So in this case, we'll take 1,600,000 and divide it by 100,000. So our rate, our predetermined MOH rate in this example is $16 per direct labor hour. Well, all we have to do now is track the amount of direct labor hours for each specific job, and then we can do the computation. So at the very bottom here, you'll see manufacturing overhead, $16 per direct labor hour, which is what we came up with, multiplied by the 500 direct labor hours, which was tracked here for direct labor on this specific job, 500, so $16 times 500 direct labor hours gives us $8,000. And we are going to allocate $8,000 to this specific job. Once we have that allocation done, we have 40, 10 plus 8. The total job cost is $58,000. The number of units is 50. Our cost per unit is $1,160. $58,000 divided by 50 units gives us $1,160 per unit. Objective number 4, determine the cost of a job and use it to make business decisions. All right, so management uses will use the job cost record to make quite a few decisions, including how do we reduce future job costs? We're going to be assessing and comparing the profitability of each model, dealing with pricing decisions. I'm going to say to you, this is probably the most important decision that has to be made. We never want to price our products for less than what they cost. If we do, we're going to go out of business. In fact, we want to price it above the costs and then some, because we still have administration and selling and administrative costs we have to cover, and then we want a profit. So we do want to make sure that our job cost record helps us with pricing decisions. But it also can help us decide whether or not there's room to allow for discounts or high volume sales. It certainly will help us in bidding for the customer orders and preparing financial statements. So really these three here, pricing decisions, discounts, and bidding, those are all really the same. That's all that. So I'm going to combine all these three, and these three together are going to be the most important. These three items are going to be combined together, are going to make it these three combined really make the pricing decisions, and that's really going to be the most important element, or the most important use of this information. And then finally, we're going to use the information also to prepare financial statements. Textbook talks about sustainability and job costing. This is more conceptual, so I'm just going to go ahead and read through these slides. Job cost records serve as a vital role for manufacturers who embrace sustainability. Sustainability, this is not short-term sustainability, this is long-term sustainability. Capture essential resources required to manufacture a product, and it provides information on how the product or production may affect the environment, employees involved in the manufacturing process, future consumers, future disposal of packaging and product itself, and then extended producer responsibility, or the EPR, which is a concept that every manufacturer has a responsibility to protect beyond just itself. Beyond just itself meaning to protect society, protect the environment. And again, when we talk about sustainability, we're talking about global sustainability. Now, we do have to take into consideration non-manufacturing costs as well. Non-manufacturing costs will include research and development, design, production, marketing, distribution, and customer service. Our total costs, we do have to take into consideration non-manufacturing costs. Our total costs include research and development, design, production, marketing, distribution, customer service. All of these costs are included in our total costs. But there are non-manufacturing costs. However, non-manufacturing costs are assigned to products only for internal decision-making, never for external financial reporting. Objective number 5, compute and dispose of over-allocated or under-allocated manufacturing overhead. Now, as we discussed, or as I demonstrated, we come up with an MOH, a predetermined rate based on estimates. And we do this before the year even starts. We come up with our rates, and once the year starts, we go for it. But because they're based on estimates, and because it's all done way before we actually start the manufacturing process, here's what we almost certainly know. That whatever we come up with an allocation, whatever we actually allocated, that's going to be different than what our actual MOH costs are. So we come up with our budget, and we know we're going to be off from our budget. We know that, there's no way we can be precise in predicting exactly how many dollars are going to be spent on repairs and maintenance. It's nearly impossible. So what do we know? We know that it's going to be off. We'll be off from our budget, hopefully not too far off, but we know we're going to be off. Now, because of this being off, we're either going to be underallocated. Underallocated means our actual MOH, our actual costs, are greater than what we anticipated. So therefore, we allocated less than what our actual was. So in other words, our actual MOH is greater than allocated MOH. Our costs were greater. We didn't expect that. So if our costs ended up being more than what we anticipated or more than what we budgeted, if our costs end up being more than what we estimated, then our actual MOH is going to be greater than our allocated. However, there can be a circumstance where our actual MOH is less than what we expected. In other words, we spent less than what we expected for the year. For whatever reason, we did. So if we are spending less than what we estimated, then our actual MOH is less than allocated MOH. If we're greater than, we call that If our actual costs are greater than allocated, then we're underallocated. We didn't allocate enough. If our actual MOH is less than our allocated, then we've allocated too much. This almost certainly will happen because we're dealing with estimates. So hopefully we won't be too far off. Hopefully we'll be pretty close, but we're going to be off. There's just no way we can be that precise when we're dealing with so many variables. Here's another graphical representation. If MOH allocated is less than the actual MOH incurred, then MOH has been underallocated, so jobs have been undercosted. In other words, it ended up costing more than what we expected. We underallocated MOH, so we have an issue. We didn't apply enough costs to our jobs. If MOH allocated is greater than actual MOH incurred, then MOH has been overallocated, and that means jobs have been overcosted. So to do this now, we know that when we're allocating these costs, they're going to the jobs, and as we're selling these jobs, they're going to go to the cost of goods sold. Once we're done with the manufacturing process, once they're sold, they go to the cost of goods sold. So one way we can deal with this is correcting our cost of goods sold for underallocated or overallocated MOH. If jobs have been undercosted due to underallocation of MOH, then cost of goods sold is too low. So therefore, we're going to increase the cost of goods sold for the amount of the underallocation. If jobs have been overcosted due to overallocation of MOH, then the cost of sold is going to be too high. Therefore, we must decrease the cost of goods sold for the amount of the overallocations. Okay, I think we'll be able to see how that works when we go through the journal entry process. So that brings us to objective number 6. Let's prepare journal entries for manufacturer's job costing. Okay, just as we've discussed before, we have our raw materials. They're going to be purchased and pushed into inventory. So we have raw materials inventory. When they're being pulled from inventory and put onto the production floor, we will consider that to be work in process. So the work in process will be the jobs that we have on the factory floor. We've just demonstrated how those costs can flow through the jobs. We're going to actually add to these jobs direct labor. So we saw how that was going to be. And then we're going to also add to the costs an allocation of MOH. We demonstrated how that's going to work as well. So we're going to take our raw materials, we're going to add the direct labor, and our manufacturing overhead costs. All these three are going to come into the work in process. Once the item is finished, it will go into finished goods inventory. And then when it's shipped out and sold, it's going to go to the cost of goods sold. Okay, so as an example here, let's take a look at the purchase of raw materials. So let's assume that Life Fitness ordered and received $90,000 of raw materials during December. So the journal entry for that purchase is going to be a debit to raw materials inventory for $90,000 and a credit to accounts payable for $90,000. So if we can see visually how this would work, I'll go ahead and put this up on a So raw materials inventory, that is an asset. So under the asset section of our accounting equation, we'll have raw materials inventory. And we're going to debit it for $90,000. Now $90,000, just to have the offset to that is going to be accounts payable. So we'll put that, that's a liability. So the credit's going to be here to liabilities. And just for kicks, we'll go ahead and, so that we can tie these numbers together, we'll put a reference of 1 because that's the first journal entry. There's no reference number here, but at least that'll help us trace. All right. The next transaction that will occur is the use of direct materials. Now we're taking raw materials out from the warehouse in the back of the manufacturing plant. We're pulling it out and staging it to start the production process. The way it gets pulled out is through the requisitions, so accountants get the requisition information and they record the journal entry. So in this case, we're going to go ahead and debit work in process inventory and credit raw materials inventory. All right. So these are going to be okay. So we're going to debit work in process inventory for $112,000. So we create an account called work in process inventory. Mind you, that's still under assets. So $112,000. and we're going to credit raw materials inventory. Now what this must assume, I'm going to put it down here so that we don't get too confused. That must assume that we have a beginning in it, because you can't add it and then end up taking out 112,000. You'll end up with taking out more than what you had. So you had to have a beginning balance, whatever that is. I don't know what it is, but it's not referenced in the textbook. So, but I just want to make it clear to you that this entry here, 90,000, means, well, the removal of $112,000 means that we had to have had a beginning balance here. I guess I could put in a beginning balance. Let's just go ahead and do that. Call it BB for beginning balance. So just that it helps us make some sense, let's assume that we started off with $50,000. Okay, that was our beginning balance. Now we're not going to worry about how that kind of worked out. So we're going to put 50,000 there just so that it helps us make some sense. We added 90, so that means we really have $140,000. Now we're taking 112. Now that makes a little bit more sense. And we took $112,000 out of raw materials inventory and we put it into work in process in inventory. Now, again, these are all assets. In fact, these are really going to be subsets of one account called, a large account called inventory. But we have details of this going on so that we're tracking everything that's flowing through inventory. Now, in our raw materials include some indirect materials. So let's assume that Life Fitness used 2,000 of the indirect raw materials during December as well. So what we're going to do is we're going to create an account called manufacturing overhead. We're going to debit manufacturing overhead for $2,000. It's going to be number 3. And we're going to credit raw materials inventory for $2,000. So 140 is what we had. We took out 112, put that in work in process. 2,000 we took out and put into manufacturing overhead. But what we put into manufacturing overhead is simply the indirect materials, okay? Assume that Life Fitness incurred 30,000 of direct labor on jobs. 30,000 of direct labor on jobs. So we're going to go ahead and create a work in progress. Well, we're going to go ahead and assign 30,000 to work in process. So that's number 4. So 30,000 will go into work in process. We'll create an account called wages payable. And we're going to credit wages payable for 30,000. Make it a little bit smaller so we can see the entire picture here. $30,000 charged to work in process inventory and 30,000 credited to wages payable. Assume that Life Fitness incurred 13,000 of indirect labor on jobs. Now, this is indirect labor, so this isn't going to go into direct labor. It's going to go into manufacturing overhead. But it's still part of the labor process, and that's going to be part of wages payable. So we're going to put 13,000. Let's make this number 5. So 13,000 goes into manufacturing overhead. That's a debit, and the credit is going to be 13,000 to wages payable. Okay. Assume Life Fitness incurs either indirect manufacturing costs. Assume Life Fitness incurs other indirect manufacturing costs, such as plant utilities, plant depreciation, plant insurance, property tax. Everything is listed right here. It's broken down on this slide, but it's going to take me forever. So I'm going to, instead of crediting all of these accounts, I'm going to just put everything under accounts payable. That makes it easier for me to put on the T accounts. So $10,000 is charged to manufacturing overhead. We know that the reality is that many of these accounts will be credited, but I'm going to make it simple for us. I'm going to put all of the 10,000 into an account called accounts payable. Okay, so I have the accounts payable. I'm going to go ahead and charge this number 6. $10,000 goes to manufacturing overhead, and $10,000 goes to accounts payable. And really, we know that it could be accounts payable, accumulated depreciation, all of these accounts. But to make it simpler, we just put it into accounts payable. Okay. Now, we've already gone through that process of understanding how we came up with the predetermined rate of $16. So that shouldn't be much of a discussion. However, let's assume that job 603 used 500 of direct labor hours, which we saw in that job record earlier as well, and that job 604 used 1,000 direct labor hours. So if we have a predetermined overhead rate of $16 per hour, we're going to compute how much gets allocated to each specific job. So as an example here, $16 times 500 is 8,000. And $16 times 1,000 is 8. So the total amount of allocated to work in process is $24,000. And the credit is going to be to manufacturing overhead. All right. So this will be number 7, $24,000. And then we're going to credit $24,000. Now I'm going to remind you that This was based upon estimated numbers that we came up with the $16 per hour. This is an actual. This is what we came up with before the year even started. So what do we know? We know that there's a very good chance that what we're actually, it's almost definitively, because there's no way you can be that precise, that what we're allocating is different than the actual. Hopefully it's not off by much, but let's hope that we're reasonably accurate. So 24,000 into work in process and 24,000 taken out of manufacturing overhead. All right, so let's assume that job 603 had a total cost of $58,000 and job 604 had a cost of $108,000, so both were completed. So we're going to take those two jobs and add them up. We come up with $166,000 of total cost. We're going to put that into another inventory account called finished goods, and when they're finished goods, we can take those costs out of work in process. So let's do that. Let's create another account called finished goods. This is an inventory account as well. So this is going to be 8. So we're putting $166,000 into finished goods. And we're going to take out of work in process $166,000. Now, finished goods is still an asset, so all of these are still under assets. We're just moving money out of work in process and charged it to finished goods, $166,000. Let's assume Life Fitness sold 40 cross trainers for 603. Let's assume Life Fitness sold 40 cross trainers from job 603 at a price of $14.25 each, and all 60 treadmills from job 604 at a price of $2,500. So we need to run those numbers. We have 40 cross trainers at $1,425 each. So let's do the math. 40 times $14.25. Then we need to do the math for the 60 treadmills at $2,500. So we're going to take whatever the result is of this, and we're going to add to that 60 times $2,500. We're going to add that as well. So we're going to do this multiplication, add the two to come up, and we should come up with $207,000. Now, we sold it. It doesn't tell us in the description here, but we can assume that it was all sold on account. So the debit's going to be accounts receivable. The credit is going to be sales revenue. This is what we sold it for. Whenever we sell units, if you recall from our financial accounting, whenever we sell something for a merchandiser, there are two journal entries that are going to have to be recorded. The first is the sale. This is the recording of the sale. We have another entry that we still have to do, but first we're going to record the sale. So let's do the recording of the sale. So we're going to go ahead and create We're going to create an account called accounts receivable. It is an asset. We're going to put it at the very top simply because in most cases receivables are going to be above inventory. So we still have all our inventory accounts that we used earlier. But now what we're going to do is we're going to create the sale. And it looks like we sold it for a total of $207,000. So let's plug that in. That's a 207,123. $207,000 is debited to accounts receivable. The credit, the corresponding credit, is sales revenue. So that's under equity. We're going to put sales revenue. So that records the actual sale of the units, the actual sale. If you dig deep back into your financial accounting, you'll remember that there's actually a second entry that has to be done. And that is, we've got to take the cost of the units that were sold and pull it out of inventory and charge it to the account called cost of goods sold. So continuing from the last example, a second journal entry is needed to record the sale. From the job cost record, we know that each cross trainer from job 603 costs $1,160 to make, and each treadmill costs $1,800 to make. We got that from the job cost record. So now we book the journal entry. So we know we have to take 40 units and multiply it by $1,160 for job 603. That's the cost of the units. Then we're going to add the 60 units that we sold and multiply that by the $1,800. We'll take that product plus the product of the 40 units and add those two together. That's our total cost. That's going to be charged to the cost of goods sold. That total cost is $154,400. So let's book that.
Yeah, I get an email from Jerry, Van Boosters Jerry, Ambit Jerry.
Okay, so our cost of goods sold is going to be charged $154,400. $154,400. And then we're going to credit finished goods. Oh, by the way, that's going to be, okay. Let's go back before we do anything else. Let's make this number 9 here. For the sale, we're going to go ahead and use number 9 to record that journal entry. Now for the cost of goods sold, we know that $154,400 is going to be charged. Since that's really part of the same entry, we'll go ahead and refer to number 9 on that. $154,400 is charged to the cost of goods sold, $154,400, and then we're going to credit finished goods inventory for the same amount, $154,400. That's number 9. So now we have the recording of the sale of $207,000 and the cost of goods sold of $154,400. But remember that $154,400 includes costs that were allocated from manufacturing overhead. So allocation means that may not be perfectly exact right now because it was based on estimates. Okay, let's move on to operating expenses. Assume that Life Fitness incurred $20,000 in salaries, commissions of $3,300, office rent of $9,400, and assume Life Fitness incurred $20,000 in salaries and commissions, $3,300 for office rent, and $9,400 for advertising. All of these are debits to operating expenses and credits to salaries payable, rent payable, accounts payable, etc. We're going to simplify this transaction and just sum all of these up. So let's do that. We're going to just create an account called operating expenses. And those operating expenses sit under equity. And it appears, let's see, we're talking about $20,000 plus $3,300 plus $9,400. So the total of all operating expenses, including salaries, rent, marketing, come up to $32,300. We could break it down here in more detail, have more T accounts, but I think you got the gist of it. And then the credit was to salaries and commission payable, rent payable, and accounts payable. Let's just go ahead and put this all again into accounts payable to make it simpler for us. So we're going to charge our operating expenses, $32,700, and we're going to credit accounts payable for $32,700. Okay. Let's go back to our instructions here. Now, here is the circumstance associated with closing manufacturing overhead. So we can go ahead and look at what our manufacturing overhead account looks like right now. Yeah, okay. So it appears that our actual costs, if we add up our actual costs, 2,000 plus 13 plus 10, we come up with 25,000. 2,013 plus 10 is 25,000. We just added it up, that's 25,000. But what we actually allocated was $24,000. So what does that leave us with? Debits of 25,000, credit of 24 really leaves us a balance of $1,000. 1,000 debit. That means our actual costs are greater than what we allocated. Our actual costs are greater than what we allocated. Well, if you think about that, that means that what we allocated to the jobs was not enough. We underallocated. If we underallocated, that means we've got $1,000, and we know it's underallocated because it's a debit. Debit is an expense, that's a cost. We underallocated. So we have to get rid of that $1,000. So what do we do with it? Well, the simplest, we've got various alternatives, but the simplest way is, let's just take that $1,000 and charge it to the cost of goods sold. Let's do it. So the last journal entry, $1,000. The last journal entry, 1,000 is going to be charged to the cost of goods sold. Cost of goods sold, we're going to have an added $1,000 cost, and then we're going to credit $1,000 to manufacturing overhead. Now, after making this journal entry number 11, if we want to add up all of the debits, that's 25,000. 2 plus 13 plus 1 plus 10. 2 plus 13 plus 10 is 25. That's 25,000. And we add up our credits. That's 25. The balance now in manufacturing overhead is 0. We were off by 1,000, but we made that adjustment. And once we've made that adjustment, we've charged the cost of goods sold that $1,000. That was more cost than what we expected. And now our manufacturing overhead account is now 0. So the income statement now will show sales revenue, $207,000. Mind you, all of these transactions were for 1 month, for the entire month. So that means we should be able to see our T accounts that way. Yeah, T account was 207. That's what's going to be listed as sales revenue. The cost of goods sold is 155,400. Well, what is the balance here? Let's go ahead and compute it. Balance 155,400. That's our debits, cost of goods sold. We take our sales revenue, subtract the cost of goods sold, and we end up with a gross profit of 51,600. Our operating expenses total 32,700. There we go. That's the debit, operating expenses. And from there, we can compute our operating income by taking our gross profit and subtracting our operating expenses. So our operating income is $18,900. Okay, moving on to objective number 7, use job costing at a service firm as a basis for billing clients. Many service companies actually bill based upon the cost. So you'll take your direct costs of serving the client. You'll have indirect costs of serving the client. The direct cost will be assigned to the client job. This is almost exactly like what we're talking about, except in the example of a service company, you're not building inventories. You're just keeping track of your direct costs and your indirect costs. They're getting charged to the income statement without an inventory, without the cost of goods sold. But you're keeping track of those costs anyway, so that when you bill the client, you bill them for your costs plus the markup. So when we're billing clients, we want to add a profit markup to the total job costs. Indirect costs are all operating expenses, they're period costs. There is no inventory. And direct costs most likely include professional labor. So the example would be my accounting firm. We would track all of our costs and bill the client plus a markup. Now, the reality is that that doesn't quite work in the real world. You have to have an amount that you normally bill based upon normal circumstances. And you bill the client based upon those assumed rates, that assumed amount of time. You bill based upon that. You can't just say, whatever it costs me, I've got to bill you. You have some latitude to that, especially if you have an extraordinary circumstance. But the fact of the matter is I have, most accounting firms have some turnover. So no matter, some employees are going to be faster than other employees. Some employees are going to get things done quicker. In some cases, it'll be faster. In some cases, it'll be more expensive. And you can't just modify your bill based upon what's going on in your office. So you come up with rates or hourly rates that you bill, your billable rates, and that really determines your sale. But you certainly want to then compare those billed amounts to the cost amounts. So you are going to keep track of your job cost so that you can compare to what you're billing and whether or not you're making money off a specific job. Here again, you'll have your indirect costs of serving your clients, including rent, supplies, advertising, and you can allocate these general and administrative or general operating expenses to the jobs similar to the way we allocate manufacturing overhead in a manufacturing company. We're going to do our estimates at the beginning of the year. Total indirect costs for the coming year, that's the budget process. We're going to come up with a cost allocation base, or what was referred to as a cost driver, and figure out how we're going to allocate those operating expenses to the jobs so that we know exactly what our basis is. And then we'll come up with a predetermined indirect cost allocation rate, similar to what we just did for our manufacturing companies. And we come up with the actual amount of allocation base times the rate gives us exactly how we're going to allocate towards the specific jobs. Now, once we have the direct costs and we add the indirect costs, which were allocated, we come up with our total cost for serving the client. We're going to add our markup, and that's the amount that's billed to the client. I wish it were that clean and that easy, but the reality is we're gonna track this and trace this, but we're gonna really do it after the fact, because you can't just modify your bill based upon what your actual costs are. There could be a lot of variables that you're not going to pass on to the customer. But this is a good basis for you to at least determine whether or not you made money in a particular job and what assumptions you made, and maybe you need to modify those assumptions in the future when you do a similar job in the future, or when you do the same work again in the future. Okay? Okay, that ends chapter 3.